fact, let's get a special corporate conversation going now. Indiabulls Housing Finance is on our radar. We have with us a lender now, Gagan Banga, the Vice Chairman and Managing Director of Indiabulls Housing Finance, to take a few questions. Gagan, thank you very much for joining in. Before we get to the Moody's upgrade on your corporate family rating to B2 from B3 and the implications of that, just wanted you to, come in on this RBI's Cleanup Act. Yesterday, it was IFL's gold loan business. Today, it's the GM products business and the directive against loan against shares and IPO financing. Are you sensing in any way a greater scrutiny on the regulatory front? And in any way, has your business been recently audited?
Yep. So, as a upper layer NBFC housing finance company, we go through at least one annual financial inspection, and that process is continuous and ongoing. Without commenting on any specific direction of RBI, since I'm not aware of what all would have gone into that, all I can say is that what is very clear is that for business going forward, we have to keep governance and compliance right at the center of everything that we do, versus an earlier attitude where compliance was more about checking some boxes and all of that. This requires a cultural transformation for the sector. I think the sector is being led extremely well by RBI, and on a longer term basis, the way to build steady stakeholder value is via good governance. You can't build good value, continuous value without good governance. So all in all, I think this is part of the overall regulatory overhaul that RBI has anyways been doing. Specifically for NBFCs, the Reserve Bank has been talking about harmonizing the regulations for upper layer NBFCs with those of banks. And I believe a large part of that is done. And I assume now that the supervision would also be harmonized and would be on the lines of banks, which overall for the sector is good.
Gagan, hi, good to have you on the show. So, before we get out of the business, just a follow-up on that. The kind of action that we have seen in the recent past, in the last couple of days, it's sort of targeted against a particular entity which was in the gold financing business. Now it's been targeted against another entity which is into sort of a loan against shares. A lot of the entities in question respond by saying that what is happening is not really a violation of norms. So these are usual business practices in these particular segments. So I just want to get your sense on whether this is about cleaning up a particular lending segment, or do you think this is more entity specific? And in that sense, I mean, you're a lender and we do want to understand the breakup of the book, but as a lender, would NBFCs start to look at these segments with a lot more caution? Basically, is it about the segment and some perhaps questionable practices in it, or is it about individual entities not sticking to the rules?
It will be very difficult for me to comment on any individual entity and whether it has stuck to the rules or not. Would be rather unfair if I'm commenting on any other NBFC. What I understand is that RBI does look at capital markets, real estate, and all such segments to be sensitive sectors. They require NBFCs to make specific disclosures around their exposures to all such sensitive sectors. And obviously, RBI has an heightened monitoring if around the exposures of NBFCs, the practices and everything else to these specific sensitive sectors, as it calls it. Overall, I believe, as I was saying earlier, that culturally we guys have to transform. We have to get ready for ensuring that a large part of the senior management time goes and gets spent on compliance, on good governance, and all of that, versus just pursuing business, etc. That is a cultural transformation. The writing is clear on the wall. And if we will postpone it, it will only be to our harm the RBI will continue to protect the sector, which it is doing quite well.
Gagan, do stay on. We want to continue the conversation to talk more about the prepayment of the FCCBs, the rights issue, which you recently concluded, and even the Moody's upgrade. But we need to get into a very short commercial break, and we'll come back and continue conversation on your business. Stay tuned.
Welcome back. You're with us on Trading Hour, and we're in conversation with Gagan Banga, Vice Chairman and Managing Director of Indiabulls Housing Finance. Gagan, so right on to business now. And there's so much that's going on, right? I believe you folks are also changing the name to Samman Capital. So tell us, when that gets effective. And also, Mr. Sameer Gehlot is completely out in terms of shareholding. So just give us a sense of how big the book is right now. What is the annual growth you're going to target? And how will the book be broken in terms of the key segments?
Sure. So we had started this whole process of overhauling the ownership as well as the governance structure of the company around 3-4 years ago now. And there was a step-by-step process. Mr. Gehlot first stepped down from the board, then reduced his shareholding to depromoterize himself, and subsequent to all approvals coming through on the depromoterization, he finally exited the company as a shareholder. So we are today truly a widely held company. 100% of our share ownership is free float. LIC of India at about 7% is the largest shareholder, and they also have a nominee on our board since they're the largest lender to the company as well. The assets under management are at about 67,000 crores. We believe that after having reduced the AUM by about 40% over the course of the last 5 years, and more importantly, by reducing our gearing to just 1.5 times as we speak, we've kind of finished with the phase of consolidation. There would be a continuing effort to wind down parts of the legacy book, and there is greater and renewed focus on ensuring that the disbursals around the retail business, which is home loans and retail loans against property given to small business owners, both of these businesses scale up. We are hopeful that we will be able to start growing our AUM this financially, as in fiscal 25, by about 15%. And that's the kind of a run rate that on compounding that we will be targeting thereon as well.
Gagan, just a follow-up question. By the way, that's really important news on IIFL Finance coming in. Fairfax has come in to offer liquidity support. I'm just going through the press release right now. This is the company's release. IIFL Finance is saying that the RBI embargo had raised liquidity concerns among the company's investors and lenders. And in response to these concerns, Fairfax has agreed to invest $200 million of liquidity support on mutually agreed upon terms. This is really, really important. Second, down circuit day on IIFL Finance, but they've got some liquidity support from one of their existing investors. So that continues to be a very, very hot story this morning as well. But Gagan, just to go back, you mentioned that the book should grow 15% in FY25. Can you tell us how much is still legacy? How much of the rundown is still pending? And if you could just give us maybe the absolute numbers as well. And what will the final book look like once you've run down the legacy business in terms of size?
Yeah, legacy business, which we've identified across all the segments that we are targeting, the wholesale as well as portions of the retail segment that we do not wish to be in, would be in the handle of about 25,000 crores. That we have systematically been bringing down at a rate of about 3,000 to 4,000 crores, and we believe that this legacy business will halve through the course of fiscal 25, and then completely run down by the end of fiscal 26. It's a good book, but it's just a changed focus for us, and we want to build a different sort of a franchise, which is more around leveraging on our distribution and credit assessment capabilities versus on the balance sheet and the capital there. So the realignment is essentially to focus and whatever capital we have, which is in the handle of 21,000 crores, devote all of that towards the retail business.
Gagan, you've also recently concluded your rights issue where you got very strong demand. There's also been a prepayment of the FCCBs. So what's the total, the balance sheet? You've given us the AUM figure, but what is the debt now? And you also have plans to increase your ROE to 15% in the next 2 years. How do you plan to achieve it?
Yeah, so ROE is going to be an outcome of ROA. The ROA had declined from being north of 3% to a low of about 1.2%. It has inched back up to 1.6%. And we expect that every 6 months, we should be able to grow the ROE by about 20 basis points, which should take us to about 300 basis points of ROE by the end of fiscal 26. And an ROA of north of 3% by fiscal 26. And thereafter, just by the proportion of regular leverage, which we intend to cap at 2 times, we will be able to generate an ROE of north of 15% by fiscal 27. The focus at this point in time is not to try and hasten up the process of ROE generation. It is to become more competitive from a cost-income perspective, to increase the franchise value, to improve our distribution and all of that. In our engagement with shareholders, we have indicated that this is the broad direction in which the company is going. And we are not in any tearing hurry to make sure that we get to these numbers by a certain quarter or anything.
Okay,
the quality
Gagan,
of the business is extremely important for us.
Got that. Gagan, very quickly, just running out of time, but some numbers would help. At the end of the rights issue, if you could just tell us what your capital adequacy levels would be. And also recently you had, ratings upgrade. So leave us with an outlook on margins. What is the cost of money that you have right now? You also prepaid some FCCBs recently, I think about 1,200 crores. So what is the blended cost of funds looking like? What are the margins that you will target for this new book and also the capital adequacy levels?
So the new book is giving us a return on asset of around 3.5% on the portion that we hold, not on the overall book. We are still focusing on the prime segment, and that's the area. So we are able to generate 100 to 125 basis points higher yields than when banks are lending to the most prime customers, given our focus on self-employed segment. Which is a slightly more detailed credit assessment, and therefore one is able to get a slight premium. So the margin, as you asked me, the return on asset that we're generating on the new book is close to about 3.5%. Cost of money for the balance sheet borrowings that we have, which have now run down and are in the ballpark of 33,000 crores from a peak of 1,20,000 crores. So we've reduced them by almost 90,000 crores. The cost of this 33,000 crores will be in the ballpark of 9%. The rating upgrade that you've mentioned is going to more be impactful on any future international issuance if you do. So we have in the past raised almost around 25,000 crores internationally in dollar-denominated loans, bonds, etc. We will continue to evaluate that market and based on opportunity, see if we can raise some liquidity there as well.
Gagan, we leave the conversation here for now. Thank you very much for joining in on your perspective on the industry and the business transformation. Get into a break. On the other side, Mitesh Thakkar will join in with his top trading bets.